Let's shift gears a little bit because one stock that's caught investors off guard is Apple. Now, this tech giant is down nearly 40% from its October highs, and the chances are you felt the hit if you're an investor. Believe it or not, Apple currently sits in more than 600 ETFs. That's why it's so important to know what you own, one of the themes of this show. Check out some of the ETFs with the most exposure to the stock. The XLK Tech Sector ETF, that's the biggest one. Vanguard VGT ETF, Fidelity FTEC ETF, that's just a few of the bigger ones. So if you're looking to get into tech, but don't want to be tied to one particular name, what should you do? So again, let's play a game. We're going to call this buy this, not that. Okay, Dave, so you're obviously, if you're market cap weighted and you're in either a broad S&P index or you're in a big tech index, you're going to own a lot of Apple. 3, 4, 5%. Again, let's talk about other alternatives, equal weighted alternatives, for example. You don't have to have something that Apple is the big monster in every single ETF you own.
Absolutely. The Invesco S&P 500 equal weighted tech ETF, which is symbol RYT, is a clear alternative here. It's a little more expensive at 40 basis points, but its exposure to each individual name is only about 1.5%. That puts your Apple exposure inside RYT half of the exposure you'd have just in the S&P 500. Currently, Apple's sitting at about 3.5% of the S&P.
Yeah, so you have 1.3% in this RYT,
right.
And what are we in the main
so in,
technology?
In,
Is it 13%?
You're looking at 16.5%.
16%.
So
that's a huge difference.
Yeah.
Okay. And Doug, you have pointed out to me many times that there are some advantages sometimes to having actively management. Now, active management is a pretty small group of the ETF sector, but it's growing. Can you make some argument here that if I want to own Apple but not so much, maybe active management is a good way?
Yeah, small but growing. I mean, one of the misconceptions about ETFs is that they're all index-based, and that's not the case. If you look at last year, 23% of the ETFs launched were all actively managed, and just like an actively managed fund, you have a portfolio manager that's picking securities. You know, there's a couple of technology ETFs that have been doing very well, actually beating the S&P 500 over the last year. You have the ARK Innovation ETF, ARKK, ARK Web X.O ETF, ARKW, both of which performing in the technology sector, where a portfolio manager is going to choose, do they want to own Apple or do they not want to own Apple? It doesn't have to be a own it all because you've chosen an ETF.
Your thoughts on active management?
Yeah, I mean, I think those are great funds. Kathy Wood, the portfolio manager there, has just absolutely hit it out of the park for the last year or two. You know, making the choice not to be 16, 17, 18% in Apple, looking at smaller, more innovative companies. I think you got a point.
And yet, as time goes on, we saw Apple's down, 40% from its high. These tend to self-correct. There is an argument for made. But there's a reason you want to own the biggest companies that are out there because they have the most influence on these sectors. It's certainly not good when it's on the downside, but we love it when it's on the upside. I didn't get anybody complaining to me about XLK and technology when Apple was, you know, up on the year dramatically.
There's a reason market cap weighting strategies are the biggest names in the business.
Yeah, it makes sense.
Yeah, and they tend to get the majority cash flows, a little bit straightforward. They tend to match with one another when you're doing building blocks in an overall portfolio.
And they tend to be cheaper, too.
That's right.